Donald Trump raised the aluminum tariffs to 50% in June.
Today we're doing copper. I believe the tariff on copper, we're going to make it 50%.
We will build Canada strong.
For decades, the United States believed it could always produce what it needed: steel, energy, aluminum. But in 2025, that assumption quietly collapsed. Today, the United States cannot meet its aluminum demand without Canada. And after the imposition of 50% tariffs, a long-standing North American supply chain did not bend. It shifted. What Washington expected to be pressure became exposure. And the numbers now show a reality that cannot be reversed quickly, cheaply, or politically. If you value fact-based, figure-driven news analysis, please subscribe, turn notifications on, and remember, the most insightful comment will be pinned to the top. On March 12, 2025, the Trump administration imposed a 25% tariff on aluminum imports under Section 232 of the Trade Expansion Act, citing national security concerns. No exemptions were granted for CUSMA-compliant Canadian aluminum. Then, on June 4, 2025, that tariff was doubled to 50%. At the same time, 407 derivative product codes were added, covering automotive components, appliances, and construction materials. The objective was clear: force concessions and revive domestic aluminum production. What followed was something else entirely. As of 2025, the United States operates 6 primary aluminum smelters. 4 are partially or fully curtailed. Average operating rate, 53% capacity. Total output, approximately 1.2% of global aluminum production. By contrast, Canada's single Sept-Îles smelter in Quebec produced 628,000 metric tons in 2024, nearly matching total U.S. output. This is not a temporary imbalance. It is a structural one. At this point, the story stops being about tariffs. From here on, it becomes a story about energy, infrastructure, and time. 3 things tariffs cannot fix. Primary aluminum smelting requires enormous amounts of continuous low-cost electricity over decades. Canada, hydroelectric power, $40 to $54 per megawatt hour. United States industrial power costs, 2 to 3 times higher. U.S. electricity demand is projected to rise 1.7% annually through 2026, driven by data centers, EV charging, residential growth. Smelters must now compete with technology infrastructure for power access. This is not a trade issue. It is an energy math problem. Recent closures underline the challenge. Century Aluminum shut its Hawesville, Kentucky smelter in 2024. 600 jobs lost.
Employees here in Hawesville of Century Aluminum received letters informing them that their company could be stopping operations for more than a year due to rising global energy prices.
The New Madrid smelter also closed. Nearly 30% of U.S. smelting capacity has been lost in recent years. Restarting or building new smelters requires 20 years of guaranteed electricity contracts, power prices near $40 per megawatt hour, capital costs of $4,500 to $5,000 per metric ton. None of these conditions currently exist in the United States. One restart effort is underway. Century Aluminum plans to restart 50,000 tons at Mount Holly, South Carolina by June 30, 2026. Investment, $50 million. Jobs created, approximately 100. Even if successful, this adds less than 10% to U.S. production, compared to the 2.7 million tons Canada ships annually. In scale, this is negligible. Instead of absorbing the tariffs, Canadian producers redirected supply. Early 2025, 95% of Canadian aluminum exports went to the United States. By mid-2025, that figure fell to 78%. Between January and August 2025, 410,600 tons of aluminum were diverted to Europe and Asia. Unwrought aluminum shipments to the U.S. declined 22% year over year. As physical supply tightened, U.S. Midwest aluminum premiums surged 139%. Prices rose sharply compared to Europe. American manufacturers absorbed the cost. Ford publicly acknowledged paying hundreds of millions of dollars in aluminum tariffs. Alcoa reported $115 million in tariff expenses. On its own Canadian production imported into the U.S., these tariffs are paid by American companies, not foreign producers. The North American aluminum industry was built over 125 years as an integrated system. Every Canadian primary aluminum job supports 13 U.S. manufacturing jobs. Canadian smelters supply the metal. U.S. factories transform it into vehicles, aircraft, and infrastructure. Canada's hydroelectric system effectively exports stored energy in the form of aluminum. The U.S. has no domestic substitute at a remotely competitive price. Canadian aluminum found eager buyers elsewhere: Europe, Spain, Germany, France, Italy, Asia, seeking stable, non-Chinese supply. Drivers of this shift: sanctions on Russian metals, capacity caps in China, demand for low-carbon aluminum. Canadian producers invested in new shipping routes, warehousing, multi-year supply contracts, European quality certifications. These relationships are not temporary. Some analysts argue that higher U.S. prices could pull aluminum back, but evidence suggests otherwise. Long-term contracts are already signed. Infrastructure investments have been made. Customer diversification reduced U.S. market risk. Canadian producers learned a clear lesson about over-reliance on one buyer. Global aluminum markets are projected to face deficits in 2025 and 2026, driven by Chinese production limits, Russian sanctions, tight scrap supply. Even a 10% reduction in Canadian exports to the U.S. could result in $2.1 billion in economic losses, 14,000 jobs impacted. Actual reductions in 2025 already exceed that threshold. The aluminum tariffs were intended to restore strength. Instead, they revealed dependence. The United States cannot rebuild capacity quickly, cannot replace Canadian supply, cannot force price concessions, cannot resolve the issue without acknowledging structural reality. Canada, meanwhile, diversified markets, maintained margins, strengthened global positioning, reduced exposure to U.S. policy volatility. What the aluminum crisis ultimately reveals is not a failure of trade tactics, but a misunderstanding of industrial reality. For decades, the United States and Canada operated as a single, deeply integrated aluminum system. Canadian smelters, powered by stable hydroelectric energy, produced primary aluminum. American factories transformed that aluminum into vehicles, aircraft, construction materials, and defense components. The system worked because it was built on geography, energy economics, and long-term planning, not politics. That system did not break because demand disappeared. It fractured because policy attempted to override structure. The belief that tariffs alone could force domestic revival ignored a fundamental constraint. Aluminum production cannot be switched on and off like a factory line. It requires decades of planning, guaranteed electricity pricing, and infrastructure that must be competitive for a generation, not an election cycle. As the data now shows, the United States does not lack ambition. It lacks conditions. Electricity costs remain 2 to 3 times higher than Canada's. Grid capacity is already strained. Competing demands from data centers, electric vehicles, and residential growth continue to rise. Even optimistic restart efforts add only marginal output, far below what Canadian supply provides today. At the same time, Canada did not retreat. It adapted.